So I have a question. Is anyone here worried about the owners of hash rate to kind of becoming apathetic towards who uses that hash rate and for what? Because that seems to be a level of fear or even like FUD that is kind of spread around that with these kind of like hash rate markets that all of a sudden people are just selling their hash rate on these hash rate marketplaces and the Bitcoin network can be bought to the highest bidder, and maybe that person doesn't actually care about the network. Is that like a realistic fear at all?
So I think this is a pretty nuanced argument. There are several layers here. One, the kind of hash rate market, the kind of hash rate market that we are discussing, we need to make a distinction that whether the buyer of the hash rate can actually vote on the chain, right? So if we're just talking about hash rate forwards, where it's just simply a financial swap where it's just USD versus Bitcoin, then the voting right of that hash rate is still with the producer of the hash rate. So in that case, the ownership of the voting is still in one place. But if let's say we have a far more advanced, much larger nice hash style market where the buyers can actually determine which chain the hash rate is going to be building on, then I think then it becomes an economics question that whether it's even profitable for the producer of the hash rate to sell it on the open market versus just to have that hash rate to himself. But overall, I think this is fair game. I think this is just part of the hash rate Darwinism that's designed in the first place.
I think this is potentially more of an issue with GPUs than it is with ASICs, where if you're mining with a GPU, you don't necessarily have any sort of allegiance to any specific chain. You can mine any GPU chain, and if some chain gets attacked and the value goes down, it doesn't really affect your bottom line. I think that is less so the case when you're talking about ASICs. Like if you're SHA-256, your future revenue, the value of all your machines, of all your hardware, is dependent on the future value of that network. So I think there's a slightly different dynamic there. I don't know if that necessarily means that one is open to attacks and the other isn't, but I do think that there's a distinction on ASIC versus GPU there.
I'd push back on that a lot, simply because, when you look at the Ethereum chain, for instance, the GPU is the ASIC. So, GPUs are dependent on the security of Ethereum in exactly the same way that SHA-256 ASICs are dependent on Bitcoin. It's all just about scale. If you abstract, away the hardware and the algorithm, at the end of the day, it's all about scale. Mining, for it to be a steady source of revenue and for it to be secure, it's just, you've got to have enough participants. And this is why chains like Ethereum Classic get 51% attacked.
I, I think you're right about the relative dominance piece of like, if you have GPUs and there's, if for Ethereum, for example, is worth the vast majority of the hash rate on GPUs. And similarly, like if you like, I don't think there's much of a barrier to not attack low hash rate SHA-256 coins if you have SHA-256 ASICs. But I think that in either case, you're not incentivized to attack the largest chain. It's just that in terms of GPU, like in terms of any specific mining hardware, whether it's a SHA-256 ASIC or you've got a script ASIC or you've got GPUs, there really can only be one stable large coin.
Yeah, but in the case of Bitcoin, there are 3 stable large coins. I know that's politically debatable, but there are 3 chains that'll have their interesting dynamics. And amusingly, they haven't, those 3 chains haven't been 51% attacked. Usually the 51%, this is something I've been doing a ton of research on, actually. So like absolutely obsessing over the reasons why the 51% attacks happen. And oftentimes it comes down to what we found is that someone was trying to test out, could they still perform a shadow mining attack in the case of Bitcoin Gold or in the case of Ethereum Classic. And, oftentimes we've found that it's actually a participant that's already been in the ecosystem that just sees an opportunity. But that's really rare. Most miners want to be a good steward. You get this for, if you look at all of the different GPU mineable coins, how many of them have actually been 51% attacked? Only 3 out of what's our sample size? 325 right now? Like 3 out of 325 is pretty damn good.
Bert,
And the question
Oh, well, the question he said, like, just to distinguish something, he said hash rate rental. So in this context, I guess it doesn't matter if we're talking about GPUs or ASICs, because we're talking about people renting hash rate. And if you're selling your hash rate to a rental agency, I guess, Jesse, you're concerned there about, like, at the capital loss, like the value loss in the specific equipment isn't relevant because we're talking about rentals, right?
I think it still is, because the question is, if that is a potential thing that can happen when you rent a hash rate, are you going to rent? Like if you're a large institution and you've got hundreds of megawatts of mining, and you could potentially get 0.1% or 0.5% more revenue doing a hash rate rental, but then there's this sort of existential risk to your business, are you going to do that? And I think that maybe your average sort of retail miner might still participate in a hash rate rental, but I think that that's something that's going to be a barrier for a lot of larger groups.
Wouldn't an institution put KYC checks in place? I mean, I know from my days working with some of the bigger companies, we need to KYC every single customer, rental or not. And even in the case of some of my clients that do offer hash rate rentals for VC funds, etc., KYC checks are always in place. We need to understand the customer. It's one of the big things that most of the North American operations require as well for the auditors. We need to understand, where we're getting money from. So do you not see that being, a common trend when we're talking about hash rate rentals?
No, I definitely think that you're going to see, if at the larger scale, people are going to require KYC. I totally agree with that.
And I think if someone executed a 51% attack on Bitcoin through a rental contract, anyone selling those rental contracts might, think twice about doing it again. I don't know if it could happen. I think it could happen. It probably will happen eventually, but I think the damage is naturally limited.
Mm-hmm. There's a really good paper that I stumbled upon by the Royal Bank of Canada that I encourage everyone to take a read of. It's Why Fixed Costs Matter for Proof of Work Currencies. And so the Royal Bank of Canada and the University of California, they collaborated on this paper to basically do an assessment on defining the security for proof of work, because no one's quite defined it in financial terms. And they came up with some fantastic algorithms, and I quite agree with their thesis. And part of their reasoning is it's not just fixed costs on the hardware. It's ensuring that costs are always predictable. So you're not going to have large fluctuations like we've had with the S9, where some folks can get them for $1,300 and then the next day, it drops down to $200. But it's also fixed costs to some degree around the electricity. And I feel like once we start getting the scale that we're seeing here in Bitcoin, chains become a lot more secure, because there is only so many ways you can squeeze out pricing on the electricity side. The utility companies have a floor. So something I'll throw out there for everyone to read. I found it absolutely fascinating. Even more fascinating that the Bank of Canada wrote a paper about proof of work cryptocurrencies.
They're getting into it. They can't help it.
Everyone's obsessed, man. Like it's
Bitcoin is a mind virus. No matter what you do, you can't avoid it at this point.